is 0, then that means the real interest rate has to be 0. So we end up with this backward bending portion of our monetary policy curve. Now also notice that if inflation turns into deflation, so that the price level is actually falling, we're continuing to move here, the real interest rate continues to rise. So if we had a deflationary environment of minus 1%, then that means that the real interest rate would be plus 1%. And again, we would be up here somewhere. So that's our monetary policy curve. So let's think about how that affects our aggregate demand curve. Right? So our axis is still the same. The aggregate demand curve has its traditional downward sloping portion. But if the zero lower bound comes into effect when we're at 2% inflation, what happens when we're at 1% inflation? If the inflation rate falls, what we saw along the monetary policy curve is the real interest rate rises. A higher real interest rate means a higher cost of borrowing. A higher cost of borrowing means less borrowing, less spending, less economic output. So with less economic output, the aggregate demand curve now has its own backward bending portion, and it becomes upward sloping. And again, if inflation falls even further, this point would also come down further. So notice then that we have a kink monetary policy curve, and that leads to a kink in our aggregate demand curve. When this happens, the dynamics of the economy change. Okay? So let's suppose we start with a negative output gap, and the zero lower bound is in effect. Okay, so that point then on our aggregate demand curve tells us the inflation rate at which the zero lower bound becomes effective. Now, in order to know where we are, we need our short-run aggregate supply curve. And that tells us economic output is at Y naught, and the actual inflation rate is below our zero lower bound level. Yep, I'm sorry. Let me call this inflation pi Z for 0. But here's where we are, right? Point A. Now, what we might want to ask ourselves is what happens in the following year? What happens in the following year? Everything else in our model stays exactly the same. We're still using adaptive inflation expectations. So the entire adjustment process is still shifting the short-run aggregate supply curve. With that negative output gap, actual inflation is below expected inflation, so the short-run aggregate supply curve will shift down. Now, when the short-run aggregate supply curve shifts down, two things happen. As we've seen in the past, inflation will shift down, but lower inflation means a higher real interest rate on the backward bending portion of the monetary policy curve. A higher real interest rate means higher cost of borrowing, less spending, less economic output. Both economic output and inflation are falling. Notice this is very different from our normal situation, where when inflation falls, the real interest rate falls, and real economic output rises. Now we have output and inflation moving in the same direction. Oops. Guess what will happen in the next year? Exactly the same thing. Now all of a sudden we see ourselves with falling inflation and falling economic output. Monetary policy, at least through the nominal Fed funds rate, is totally useless in terms of preventing this. Okay? What we found ourselves in is what is sometimes described as a disinflationary spiral. A disinflationary spiral. Inflation rate is moving lower and lower. If the inflation rate started low enough, we could get ourselves into a deflationary spiral, where prices are actually falling. Much more dangerous than just the disinflationary spiral. So if we think about that and come back to our diagram, the Euro region is at the zero lower bound. They also now have an inflation rate of 0.4% per year. Okay? So they're about as close to zero as you can get. It'd be very easy for them to fall into deflation. The U.S. is also at the zero lower bound, but our inflation rate right now is about 1.5%. So even if this situation persisted in the United States, we've at least got a bit of a cushion to work with. The Japanese, on the other hand, are also very close to zero. In fact, they've actually just managed to pull themselves above zero for the first time in a couple of years. So the question then becomes, what do we do about this? What do we do about this from a monetary policy perspective? Okay. Now, our so-called conventional or traditional tools of monetary policy, open market operations using short-term government debt, because with traditional open market operations, the central bank is trying to affect short-term interest rates, it involves itself in buying and selling of short-term government debt, or changes in discount loans, or changes in reserve requirements. All of these things were in our money multiplier, right? The first two were the monetary base. The reserve requirements were in the multiplier itself. That's traditional or conventional monetary policy. It's basically off the table. It doesn't help at the zero lower bound. So that means then that the central bank is likely to try non-conventional tools, right? Non-conventional tools. So these are referred to as quantitative easing and credit easing, which are related, which can involve both liquidity provisions as well as asset purchases. It can also, in a very different way, try to use expectations, changing people's expectations, about either short-term interest rates or inflation, something that is often called forward guidance. Now, we need some definitions here. Quantitative easing is any large increase in the central bank's balance sheet. It could even be a very large increase in the central bank's balance sheet from short-term government debt. Now, that needs to be thought of somewhat differently from what we refer to as credit easing. Credit easing is a form of quantitative easing, but it's looking to make a change in the composition of the balance sheet, away from short-term debt into other types of assets, generally medium to long-term government securities or medium to long-term private assets. If we're only doing quantitative easing, but not credit easing, that is, we're still doing this in terms of short-term government debt, it's unlikely that we are going to affect the real interest rate. The whole idea is to drive down the real interest rate, but they can't drive the nominal rate any lower. So the real interest rate won't fall. Financial frictions won't change. The interest rate that the private sector borrows at won't change. So it's not likely to have any sort of meaningful impact in terms of what's happening in the economy. The Japanese central bank, the Bank of Japan, did this type of quantitative easing about 5 years ago. Massive increase in their balance sheet, but it was all short-term government debt. As best as anybody can tell, made absolutely no impact on the economy at all. Now, if there's credit easing, so now we're buying other types of assets, longer-term assets or private assets. Again, it's unlikely to affect the short-term real interest rate. The nominal rate's not changing, so it doesn't make any difference. But it can change either the term spread, the difference between long-term interest rates and short-term interest rates, or the credit spread, the difference between risky assets and the risk-free asset, the government bonds. Right? So that would reduce financial frictions, and that would bring down the interest rate that businesses borrow at. So it may have a meaningful impact. But notice that it will only have a meaningful impact if there is more borrowing taking place. So far, we don't have any more borrowing taking place, or much more. Now, when we actually do quantitative or credit easing, we can do it either through liquidity provisions or asset purchases. Liquidity provisions simply mean that we're injecting liquidity into impaired financial markets. One of the things that happened during the economic crisis in 2008 is people did not want to lend money to counterparties. They were very worried about being repaid. So things like the commercial paper market, money market funds, all kind of seized up. Nobody really wanted to lend any money. The central bank stepped in and said, we'll lend. We'll provide liquidity to these markets until they get restarted again. And so that's what they ended up doing. The whole idea is when impairment begins, financial frictions widen out. The liquidity provisions is to bring those financial frictions back down and move the IS and AD curves to the right. Asset purchases involve either long-term government securities or private assets. Right? And again, here the idea is to bring down long-term interest rates or to bring down the interest rates associated with private securities. Again, to the extent that this would be successful, financial frictions would be reduced and the IS and AD curves would shift to the right. So this just shows us what has happened in here. So here we can see where the crisis began. And most of this part here are liquidity provisions. So these other assets. These mortgage-backed securities are buying private assets. So that's an asset purchase. And most of what was going on in here was the central bank buying longer-term government securities rather than shorter-term. So that's also an asset purchase. Now, it was basically substituted for buying short-term assets. So as you can see, it didn't really grow too much until recently. Now remember, this stops at the beginning of 2011 when it was only $2.5 trillion. So the Federal Reserve just stopped their quantitative and credit easing last month at $4.3 trillion. So it's a lot bigger now. So what are they trying to do? So the whole goal of this quantitative credit easing is basically to shift the AD curve to the right by reducing financial frictions. To the extent that they can be successful in doing that, economic output would rise, and so would inflation. Now you'll notice, at least the way I drew it, they're still not back at potential. They're still bound by the zero lower bound. So in the next year, they'd have to do some more. Again, but the whole idea is to shift the aggregate demand curve to the right. The second kind of tool that they have is trying to change expectations. And the expectations that they can change are either expectations for short-term interest rates or expectations about inflation. So when they try to change expectations for short-term interest rates, what they're really trying to do is affect long-term interest rates. If I say, for instance, that short-term interest rates are going to be very low for 5 years, then interest rates for 2 years, 3 years, 4 years, and 5 years are also going to be really low. Right? Because there's an arbitrage opportunity between borrowing money overnight at very low rates that are going to stay that way and borrowing money for 1, 2, 3, 4, 5 years. So this will help to bring back down longer-term interest rates and therefore reduce financial frictions. Again, if it's successful, it would shift the aggregate demand curve to the right. The second thing that they can do is try to increase people's inflation expectations. So this is what the Bank of Japan has tried to do recently. So about a year and a half ago, maybe 2 years ago now, the Bank of Japan said, we are going to do everything in our power to raise inflation. Now, inflation in Japan at the time was actually running slightly below zero. And the central bank says, we're going to do everything that it takes to get inflation up to 2% sometime in the next 2 years. Now, remember, central banks can do a lot, right? Because central banks can target inflation. And the central bank started buying assets left and right, massive amount of quantitative easing and credit easing. And sure enough, people's expectations about what inflation was going to be changed. They jumped to 1.5%. Not 2, but they jumped to 1.5. Notice that if that happens, the short-run aggregate supply curve shifts up, economic output rises, and inflation increases. So they were successful in doing that, but as I've drawn this, it still has not had the effect of getting us back to potential output or getting us to the point where we could get off of the zero lower bound. So they need to do more. They need to move that aggregate demand curve to the right. They haven't been successful enough in doing that. Now, all of these policies, non-conventional policies at the zero lower bound, can be thought of as experimental medicines. We haven't used these in the past. They were not used very extensively either here or elsewhere when economies were at the zero lower bound. So the jury is still out on exactly how effective these kinds of policies will be. Have a good weekend, and I'll see you on Tuesday when we'll start talking about exchange rates.